Hi everyone and welcome to our Made for YouTube series. I am Sumaira Apti. So earlier this week I was reading a very interesting blog when I came across the terms fast risk and slow risk. And I thought it would be something very pertinent for mutual fund investors. So here's my attempt at explaining this concept. So first let's understand what each of these terms mean, right? Fast risk is basically the undesired outcomes which are usually, immediate and devastating. When somebody tells you, don't drive without a seatbelt, you can die. Or as an investor, you may be told, don't use too much leverage, you can go broke. Well, those are examples of fast risk where any one single action can cause, untold damages. With fast risk, there is usually a very hard break between how your life was before and after the event. On the other hand, slow risk is the accumulation of years of bad decisions, sometimes years and years of bad decisions, which finally lead to unwanted outcomes. It's like developing heart disease because of years or decades of not eating well, or waiting endlessly for the market to crash so that you can finally buy that dip. Like the author of this blog says that with slow risk, there's no one single event that you can point to and say, that's where I think I went wrong. It's the cumulative effect of, many years of taking bad decisions. So let's focus then on, how this matters to your portfolios. So as investors, we have evolved through trial and error or even the experiences of others to learn to avoid fast risk, at least to a very great extent. And somewhere at the back of our minds, we may have even developed a bias against it. I know people who will keep lakhs and lakhs in a bank FD because they're too scared of the risk which they perceive to exist in the stock market and by association in mutual funds too. But here's where we must pause for a moment to wonder whether this bias against fast risk is actually harming your investment. For example, the stock market has plenty of fast risk, but there is little to no slow risk. The Nifty could drop 20% tomorrow, but 30 years from now, it's very likely that it will be much, much higher than what it is today. So the fast risk here is of a 20% drop tomorrow, but there is no slow risk because if you're a long-term investor, then the overwhelming probability is that you will have made plenty returns in the next 20, 30 years. On the other hand, cash has lots of slow risk, but little fast risk. Next year, the rupee will probably be pretty much worth the same as it is worth today. A little bit here and there, of course, but largely the same. But 30 years from now, not so much. The rupee will rarely crash, and so the fast risk is negligible. But over the long term, it cannot sustain its purchasing power. And so we can say that the slow risk in the case of holding cash is overwhelming. So, the bias against fast risk means that we as investors have a bias against assets which can build wealth over the long term. Like we just saw that stocks may lose value in the short term, but usually add value over the long term. And for all of those who prefer the safety of a bank fixed deposit, we're already seeing negative real returns. So avenues like savings account or even bank FDs are no longer risk-free. Yes, they are free of fast risk, but they are not free of slow risk. So every time, a stock crashes or a mutual fund faces a default, you will probably hear about it. But you will never hear about the person who sat in cash for 20 years because they were too afraid to get invested and therefore never generated any wealth. What's hard to notice in the short run becomes impossible to ignore in the long run. But, make no mistake about it. Fast risk or slow risk, both can be equally damaging and devastating. It all boils down to having that judicious mix of different assets in your portfolio which are aligned to your goals and then not getting distracted by the noise around you. So every person out there needs to ask themselves if their portfolio is taking more slow risk than they realize, or has the market rally subconsciously made you pile on extra risk which you otherwise wouldn't have taken. You know, just like being too risky is detrimental to your portfolio, so is being too cautious. We must make conscious decisions, whether it is to avoid risk or whether it is to add some risk for the long term. Neither should be decided just by our inherent biases. So I hope, this helps to provide some insights into your long-term wealth creation journey. I'll be very happy to take up any questions that you may have arising out of this topic. So I look forward to reading all of your comments and suggestions. Thanks very much for watching. Stay safe.